we will be talking about how costs flow through the accounts in a manufacturing firm. There are two key portions of GAAP that are relevant for this section. One is the time period assumption, which says that we divide the life of a business into artificial time periods and we measure the results of operations within that time period. Because of that, sometimes it doesn't really matter whether an event occurred on a Monday or a Tuesday, because both Monday and Tuesday are part of the same accounting period. However, there are other times when it actually does make a big difference if Monday is the last day of one accounting period and Tuesday is the first day of the next accounting period. The other piece of GAAP that is relevant here is the matching principle, which says that we match our expenses to the revenues that they help us to generate. Because of that, we record all of our product costs initially as inventory, and we have to wait until the end of the period to know whether the inventory was sold or not. If the inventory was sold, then all of the costs associated with that inventory should end up as part of cost of goods sold on the income statement. But if that inventory was not sold, then those costs will be capitalized onto the balance sheet because they haven't generated any sales revenue for us yet. Generally speaking, a manufacturing firm can have 3 inventory accounts, and you need to understand each one and the story that it is telling. The raw materials inventory represents the dollar value of all of the materials that we have acquired but haven't used yet. The work in process inventory represents all of the units that we have started to manufacture but haven't finished manufacturing yet. And the finished goods inventory represents the dollar value of all of the units that we have finished manufacturing but haven't sold yet. So let's take a look at the flow of costs through these accounts. In the raw materials inventory, we probably start out with a raw materials beginning balance. That represents the dollar value of all of the raw materials that we purchased before this period began. At the end of last period, we took a physical inventory, so we know how much raw material we had at the end of last period, which automatically becomes the amount of raw materials that we have at the beginning of this period. During this period, we also add new purchases. So the total amount of raw materials that we have available to us during the period is the sum of the old materials plus all of the current purchases. Now, what happens to all that raw material? There are only 2 possibilities. Either it gets used or it doesn't get used. At the end of this period, we take a physical inventory to find out how much material wasn't used by the end of the period. In that case, we can take the dollar value of all of the material that was available for use, subtract out the dollar value of the raw material that clearly didn't get used because it's still in the warehouse at the end of the period, and the difference will give us the dollar value of all of the material that did get used. Now let's take a look at the work in process inventory. We know that we have 3 factors of production: direct materials, which can be traced because we know how much we used, and direct labor, which can be traced because we know what our workers were working on during the period, and manufacturing overhead, which we can't trace. There's no way to tell how much of our overhead items went into the various products that we manufacture, so that amount may have to be allocated. Altogether, the material and the labor and the overhead that we used gives us our total current costs. Now we have to think about whether we have any old work in process costs from the previous period. That depends on what it is that we're making. If we're manufacturing something that doesn't last very well, that must be finished when it started, then our work in process beginning balance is always going to be 0. That means we never have anything partly manufactured left over from last period. For example, if we manufactured ice cream, there's no chance that we would start a batch of ice cream one day and not finish it until the next period. However, what if we manufacture toaster ovens? In that case, it is perfectly possible that we would have some partially manufactured toaster ovens at the end of one month and then come back at the start of the next month and finish those units and start other units. So generally speaking, we can say that our work in process beginning balance, partly finished units from last period, plus all of our current costs equals our total manufacturing costs. Now, what happens to those units? There's only 2 possibilities. Either the units get finished this period or not. So we can take our total manufacturing costs and subtract out the dollar value of any units that didn't get finished this period. That's our work in process ending balance. And the answer to that math problem is called cost of goods manufactured, which represents the dollar value of all of the units that did get finished this period. Now, what happens to those units? They don't stay in work in process. They're transferred to finished goods. So in our finished goods inventory, we may have a finished goods beginning balance, which represents the dollar value of units that we manufactured before this period ever started, but they didn't get sold yet. We add to that the cost of the goods that we manufactured in this period, and altogether that gives us what's called cost of goods available for sale. That's the dollar value of all of the goods that we could sell to our customers during the period. So how do we know what we did sell? we take the dollar value of our cost of goods available for sale minus the dollar value of all of the goods that we didn't sell because they're still in the warehouse must equal cost of goods sold, the dollar value of all of the goods that we did sell. And that number goes on the income statement because all of the units that we did sell generated sales revenue, and because of that we can match the cost of those goods to the revenue that they generated to find gross profit. But our raw materials ending balance, our work in process ending balance, and our finished goods ending balance all end up on the balance sheet because we know for sure that they are not associated with generating revenue yet. When they do, when they become goods that are sold, then their costs will move off of the balance sheet and onto the income statement. So let's take a look at an example. We're given a whole bunch of information about the XYZ manufacturing company. And the question that we're trying to answer is, what is the cost of goods sold for this firm during the month of March? To answer this question, we are going to go back to the formulas that we just finished discussing. So step one, we are going to find the dollar value of all of the materials that we used during the month of March. So we start out with our materials beginning balance. That is, materials that we had bought before March ever started. During March, we bought more materials. Altogether, the old materials plus the new materials equals all of the materials that we could possibly use. So what happened to $82,000 worth of materials? Either it got used or it didn't get used. In this case, we're told that at the end of the period, there was $21,000 of materials that didn't get used. The only way we can explain that is that $61,000 worth of materials must have been used. Now we're ready to go on to step two and find the total manufacturing costs for March. We remember that we have three factors of production. Direct materials, we just figured out in step one. That was $61,000 worth of materials that got used. Direct labor we can find by going back and looking at the data. And we're told that that was $48,000 worth of labor costs. Now, what about manufacturing overhead? In this case, they don't tell us the total manufacturing cost. They tell us different components of overhead. Indirect labor, factory supervision, factory utilities, and factory depreciation. Add them all up, and that tells us we had $42,000 of manufacturing overhead. Add that to the materials and the labor that we used, and that tells us that our total manufacturing costs for March equaled $151,000. But did all of those costs become associated with units that got finished? We need to go on to step three to answer that question. we know from the previous step that we had $151,000 of current manufacturing costs. But on March 1st, we already had $54,000 worth of partially finished units that we had started in February but hadn't finished by the end of February, so they were still sitting around partially completed on March 1st. So altogether, we have $205,000 worth of costs. Now, did it all get finished? We know it didn't all get finished, and the reason we know that is that at the end of the period, we have $73,000 of work in process ending balance for March. That is, units that we started in March but didn't finish by the end of March. We'll finish them next month, but they're not finished yet. So if we take the $205,000 of costs for units that we might have finished and subtract out the cost for units that clearly aren't finished yet, that tells us that the dollar value for units that did get finished in March is $132,000. Now, in step 4, we'll figure out the cost of goods available for sale and the cost of goods sold. So we just figured out that we have $132,000 worth of newly finished goods. In addition, we're told that we have $33,000 worth of goods that were already finished before March ever started, and those goods are sitting in our finished goods warehouse. So altogether, we could have sold $165,000 worth of goods. Did we sell them all? Actually, we know we didn't. And the reason that we know that is that we're told we have $29,000 worth of finished goods still in the warehouse at the end of March. The only way that we can understand that is that we must have sold $136,000 worth of goods. So now, this is a schedule of cost of goods manufactured and sold. It looks really complicated, but it's actually just a compilation of everything that we figured out in the previous steps. Let's take a look at it. Up here, we have our heading. Every financial document that you ever produce has to have a heading. That includes the name of the firm, XYZ Manufacturing, what kind of financial document it is, in this case, a schedule of cost of goods manufactured and sold, and then the period of time that it covers, in this case, the month of March. Now let's see what we can find in this maze of numbers. Over here, under manufacturing costs, this represents our computation of how much materials we used during the period. We already had $12,000 worth of materials. We bought another $70,000 worth of materials. That means we might have used up to $82,000 worth, but we know that $21,000 worth was still in our materials inventory at the end of the period, which means we actually used $61,000 worth. Now, to the materials, we can add our labor and we can add our overhead. Altogether, our materials, our labor, and our overhead equals $151,000 worth of current manufacturing costs. Now we can add to that our beginning work in process, and that gives us our total manufacturing costs minus the dollar value of the work in process that didn't get finished must equal the dollar value of the work in process that did get finished. Add to that all of the finished goods that we had already made in previous periods, and that gives us the total value of the cost of all of the goods that we could possibly sell, minus our finished goods ending balance, the dollar value of goods that clearly did not sell because they're still in our finished goods inventory, and the answer represents cost of goods sold. So now, the dollar value of our ending materials, ending work in process, and ending finished goods will show up on the balance sheet under assets, whereas cost of goods sold will go to the income statement as part of our computation. Sales revenue minus cost of goods sold equals gross profit.